If this is your first time on the channel and you want to know everything there is to know about living in Redondo Beach, California and the surrounding South Bay area, then hit subscribe so you can stay current in what's happening in Redondo Beach. My name is David Coe. I have lived in Redondo Beach for over 30 years and been a realtor for the last 20. Myself and my team at the Coe Real Estate Group, we love to help people navigate the move here to Redondo Beach. And whether that's 9 days or 900 days away for you, we would love to be connected with you. All of our contact info is in the description, and we'd be happy to help you make a smooth move to Redondo Beach or the South Bay area. Hey everyone, welcome back. This is David Coe, Coe Real Estate Group. We're here once again with some great information about home ownership, buying homes, investing in homes. And today I brought in my good friend Heath Goldman, who has all kinds of interesting strategies. If you are an investor and you're looking for different ways of mitigating or deferring capital gains on an investment property other than doing a 1031 exchange, he specializes in that. First of all, Heath, happy birthday. I know you've got a birthday this week.
Thank you, sir.
And more importantly, you just finished attending the 17th annual Waltz Pullman Lane Crawfish Boil. How were the crawfish this year versus last year?
Well, some of those were big. Those look like mini lobsters, some of them. They were some nice sized ones in there this year.
They were, even the claws were big this year.
Yeah.
It was good. Well, as always, appreciate you coming out. It was great seeing you and the fam. So thanks for coming out. But other than eating crawfish and getting a year older, what else? Tell us about yourself.
At least I'm getting a year older. At least I can talk about it, right?
That's right.
I've been in the financial services space for 32 years now, and mostly dealing with clients that own one of two types of assets, either a closely held business or real estate. So I've always appreciated the rooms that you put me in, and being a resource for you and your investors and your team.
Yeah, look, you do something different, right? But it's super important. I love getting your perspective and helping to open people's minds on different things. So I know you've got many tools in your toolbox, and every patient probably needs a different prescription. But the one that I think you've talked the most on to help mitigate capital gains is using a charitable remainder trust. So why don't you start off and kind of talk about, well, first of all, talk about what a gain is, just in case someone doesn't know, and then kind of talk about how you can help mitigate that using these different kinds of trust.
Yeah, sure. Thank you. Obviously, the purchase price plus any improvements that have been made to the property will be your cost basis, and anything above the cost basis would be considered gain upon the sale, less the the expenses of the of the transaction.
Yeah, and which includes real estate fees, and includes all the escrow fees, title fees. But we live in California. Someone has owned a piece of property for 20 years, 30 years. That's a lot of appreciation over the years, and especially on when you're looking at investment property. So let's say I bought a duplex for $400,000 10 years ago, and now I'm looking to sell that, and I made additions and improved it, and it's now worth $2 million. I've got more than $1 million of gain. I don't want to do a 1031 exchange. I'm looking for something different. How would I come to you and use a charitable remainder trust to help mitigate that tax basis?
It's something else to add on to that math, though, David, is if you depreciated those assets over time as well, you've got to recapture depreciation. So you could be looking at north of 40% really total cost in terms of taxes in that. And, I always tell people, a lot of clients just don't want to be landlords anymore. They don't want to have to deal with the 4 T's: taxes, termites, tenants, and trash. And there's probably more than 4 T's. But the Charitable Remainder Trust, although I use the term Charitable Remainder Trust in presentations, I do call this thing a tax-exempt trust, because let's be honest, a lot of people don't understand that the charitable planning strategies can be great tax mitigation strategies. They think that they have to be charitably inclined. And when you look at the math associated with it, many times, even a client who is not charitably inclined will be better off using a CRT for the exit. So essentially what happens is a client creates this CRT. Yes, it's typically a lawyer that's going to draft the document. The asset is then transferred into the CRT. Then the client, typically as the trustee of the CRT, is the one that's going to be making the sale, but the proceeds are going to go to the CRT which according to the code section is a tax-exempt entity. And that's where you get your tax deferral. So if you are going to net $1.5 million, then pay taxes, well, you could be looking at $1 million to live off of in your golden years. But if you have this CRT and the transaction, you would be netting $1.5 million, giving yourself and your wealth manager potentially an extra $500,000 to put to work for you and your family in your golden years. And that, $500,000 is a lot more money in your pocket than it is than it is being used by the government in form of taxes.
And the money stays in the trust and it's invested in, more traditional assets, correct? Is that what happens?
Most likely, because if you wanted to stay in the real estate market, then you could have had it done and just gone and done a 1031, like you mentioned before. But if you are looking for an alternative to a 1031, the CRT is definitely a good one. And more importantly, yes, you can invest in more traditional assets to give you those anticipated returns.
How do I get my money out of the trust, right? Like, so if I set this thing up and the property sells, like what happens after that? As someone who is the trustee of that trust, how would I receive money to live off of?
Great question. So it is either it's typically in an annuity structure. It could be a fixed annuity price, so we would set that up at the onset of the trust, or it could be a variable, depending on if the client is willing to accept the increases or decreases in the value of the time. So if you've got $1 million, let's use the math of $1 million to make the math easy, and you've got an 8% trust, is that $80,000 every year, or is that 8% of the reappraised value of that trust on an annual basis? So if it goes to $1.1 million, well, now it'd be $88,000 of income versus $80,000 the first time. But if it drops, you still would have the downside too. So really depends on if you need to be on a fixed income or if you have the ability to allow that to continue to grow, which would increase the cash flow over time.
If an investor had multiple properties, would you need to set up one trust on top of each property, or can one trust hold multiple investments in it?
The answer is yes. It can be that it could be either or. You do not have to set up a new trust for each property. It could be one trust for all of the properties, but that's really going to be a function of the objective of the client at the end of the day. But it could be done either way.
If it was something where I was going to sell one now and then maybe 2 years from now versus selling a portfolio all at one point in time, would that matter in my decision on how many trusts I have?
Yes, very much so. I mean, most likely you're going to want a separate trust if you're doing something 2-3 years down the road, potentially. But it is possible to look at what that looks like.
And then when the money comes out, am I taxed at that point in time, or is that tax-free revenue?
No, absolutely not tax-free revenue. It is definitely taxable. And the question is, they're going to get their piece.
I tried.
They're going to get their piece over time. Are they going to get their piece up front? No, but it also will depend on if the money is allocated and managed properly. I would say, from a tax perspective, it's most likely going to come out at capital gains rates versus ordinary income rates. But if it's not managed properly, from a tax perspective, not that the money manager is doing anything wrong, it could come out as partially ordinary, partially capital gains. It just depends. So you have a better shot at having all capital gains if you have all capital gain assets being managed inside the trust.
Yeah, and I think the thing that's important is the time value of money, right? If you had to pay everything at the sale, you're paying all that tax in today's dollars. If you can push out the taxation of that and you're paying taxes over time, every year that goes by, you're paying maybe the same dollar amount, but the value of that dollar amount is less because of inflation and everything else. So you might pay the same dollars, but you're getting it over a longer period of time, which may make it less.
And more importantly, I think you have more money working for you quicker to achieve your longer term results. So an extra $500,000 growing is obviously going to produce a much larger nest egg than only $1 million starting point. So, but you're correct.
I know another option that you're involved with are DSTs, and I know there's two kinds. There's the Deferred Sales Trust, and there's a Delaware Statutory Trust. You're more of the Delaware Statutory Trust, which is also a great way for that investor who's tired of dealing with tenants, trash, toilets, and whatever the other T was. Why don't you talk
Taxes.
about like taxes? That's right. Yeah, how can we forget about that one? The
Yeah,
most
exactly.
expensive of all of them. Why don't you talk about what those look like and kind of how you would help someone in one of those instances?
So the four that I was thinking about before is toilets, tenants, taxes, and termites. You added trash, but I can't forget the toilets. Okay, yeah, the deferred sales trust essentially is going to be a more of a managed approach. You are buying into a what I would call mailbox money. Okay, somebody else is going to manage the property, somebody else is going to acquire the property, and they're basically going to send you a check on a monthly or quarterly basis. And that's really how the deferred sales trust is. Large apartment complexes, large student housing, large industrial portfolios that are professionally managed, where you are basically just buying a piece of the cash flow versus having anything that you do in terms of management, but they do qualify for 1031 status. So it is a nice option for people who are looking for a alternative to a 1031 for sure.
We had a client sold I think it was a 12-unit building in Venice, and if you can imagine what the tenant basis is like in Venice, California, a lot of turnover, a lot of damage, a lot of stoner bros that just forget to pay their rent, and he was tired of it. So we sold the building, he took it, and then he bought shares in multiple DSTs. DSTs are really like little syndications that just have this tax advantage status, right, where you can 1031 exchange into
It's a
them.
great way of saying it. Correct.
And then basically, is that your role as a financial advisor? Is you have access to different kinds of Delaware statutory trusts out there that someone could explore and look at the differences between, multiple different DSTs?
Absolutely. And
Yeah.
different types of real estate,
Yeah.
depending on what a client's interests are. But a diversified portfolio of DSTs makes a lot of sense from your client's perspective.
Yeah, and then I also know some of these DSTs, they're diversified, right? Like you might buy shares in one and it could have a range of assets. It could be geographically diversified. It could be geographically the same, but asset diversified. So there's diversifications in some of the DSTs, and you can diversify against multiple DSTs depending on how much money you have to exchange out.
Absolutely.
Yeah. Well, good. And I know besides, yeah, go ahead. Sorry.
I'm sorry, I'm going to mention one other strategy for a larger portfolio exit might be something called a private placement life insurance policy. I don't want people to get hung up on traditional life insurance where you're using it for the death benefit portion as opposed to the tax advantages of life insurance. But for a larger portfolio, the PPLI could be a valuable strategy as well. But my
And,
job really at the end of the day is to talk to clients, understand the facts, understand the goals and objectives, and figure out what the right solution is for them and their family.
and I think you mentioned it earlier, but just to reinforce it, this isn't just real estate. This is also privately held businesses. And sometimes those have way larger gains than what we're even talking about with real estate holdings. So either way, if they have a gain, they should consider talking to you and looking at alternatives to paying all the taxes on it.
Yeah, for sure. The PPLI doesn't. The CRT could work for closely held businesses. Could be crypto. I've seen a lot of crypto wealth that's been created. But yeah, so it definitely is not only in the real estate space, but if you've got a gain or if you've got substantial income that's being taxed, I might be a solution.
Awesome. Well, Heath, I appreciate you carving out some time today for this. If anyone here has assets and they have a gain and they're looking for different options on how to mitigate that gain, if you want to call me, I'll connect you to Heath. We're going to put Heath's contact information down below. Feel free to reach out specifically to him. Heath, thank you so much for your time today.
Thank you for yours. Always enjoy being with you in your community.
Awesome. If you like this video, please hit like below, subscribe. We do all kinds of great content focused here in Southern California, specifically in the South Bay, about owning and managing real estate. It was great seeing you today. We'll see you next time.